Hello and welcome to Traders Wealth Academy. Today, we'll be discussing the terms you'll frequently encounter in Forex trading and what you need to know as you step into the world of Forex. The Forex market is filled with its own set of terms and jargon. So, before you dive into learning how to trade in the FX market, it's important to understand some of the basic Forex terminology you will encounter on your trading journey. If you find this information helpful and want to learn more, please subscribe to our channel. We regularly publish informative and educational content like this. Ready to get started? Let's dive in. Basic Forex terms. To start with, let's understand the basic terms used in Forex trading. Our first term is cross rate. Cross rate. A cross rate refers to the exchange rate between two currencies, neither of which is the official currency of the country in which the exchange rate quote is given. For instance, if the exchange rate between the British pound, GBP, and the Japanese yen, JPY, is quoted in an American newspaper, it is considered a cross rate because neither the pound nor the yen is the standard currency of the US. However, if the exchange rate between the pound and the US dollar, USD, is quoted, it would not be considered a cross rate because the quote involves the US official currency. This term is crucial for companies and investors involved in international trade. Understanding cross rates can make trading more complex. That's why grasping cross rates is critical for companies and investors engaged in global trade. Cross rates are also important for investors looking to capitalize on arbitrage opportunities in currency pairs. For example, an investor in Europe might use cross rates to profit from the euro strengthening against the yen. Such transactions allow investors to gain from currency fluctuations. Exchange rate. An exchange rate is the value of one currency expressed in terms of another. For example, if the euro to US dollar pair is 1.3200, this means 1 euro is worth 1.3200 US dollars. Exchange rates constantly fluctuate based on global economic conditions, political events, and central bank policies. Exchange rate movements reflect a country's economic health, inflation rates, and interest rates. Fluctuations in exchange rates directly affect import and export costs. For instance, if the euro gains value against the US dollar, it increases the costs for American companies importing from Europe. Similarly, the cost of a holiday in Europe for an American tourist will vary with exchange rate movements. Such fluctuations can impact business budgets and profit margins. Therefore, closely monitoring exchange rate movements is vital for businesses and investors. Pip. A pip is the smallest price movement a currency can make. For the euro to US dollar pair, 1 pip equals 0.0001. This means if the pair moves from 1.3200 to 1.3201, it has moved by 1 pip. Pips play a crucial role in trading strategies and risk management. Understanding pip calculations helps traders evaluate potential gains and losses. Pips are the fundamental units for calculating profit and loss in Forex trading. Traders adjust their positions and develop risk management strategies based on pip movements. Accurate pip calculations are essential for successful trading. For instance, a trader could gain or lose $1,000 from a 100 pip movement. Therefore, understanding how to calculate and use pips in your trading strategy is key to becoming a successful Forex trader. Leverage. Leverage allows you to open a position larger than your account balance. If you have $1,000 in your account and a leverage ratio of 100 to 1, you can open a position worth $100,000. Leverage can amplify your gains, but it can also amplify your losses. Therefore, It is crucial to use leverage carefully. Using leverage offers the potential for high returns, but it also brings significant risks of large losses. Therefore, before using leverage, you must assess your risk tolerance and develop appropriate risk management strategies. Leverage trading allows traders to maximize their gains from market movements, but these trades must be managed carefully. Real-life story. When I first started, I learned the advantages and disadvantages of using leverage. After a few successful trades, I increased my leverage to earn bigger profits. However, after experiencing a few significant losses, I realized I needed to be more cautious when using leverage. You might face similar challenges in your trading journey. The key is to learn from these experiences and adjust your strategies accordingly. Using leverage offers the potential for high returns, but it also brings significant risks of large losses. Therefore, before using leverage, you must assess your risk tolerance and develop appropriate risk management strategies. Leverage trading allows traders to maximize their gains from market movements, but these trades must be managed carefully. Margin. Margin is the collateral needed to open or maintain a position. If you have $1,000 in your account and a 1% margin requirement, you can open a position worth $100,000. Margin is the amount required to keep your position open. If you don't have enough margin in your account, your broker may close your position. Margin management is a crucial part of risk management. I will explain how to avoid margin calls and use your margin efficiently. Using margin allows traders to open larger positions, but it also increases the risks. Margin calls occur when the equity in your trading account falls below the required margin level, requiring you to add more funds or close positions. Therefore, understanding how margin and margin calls work is critical for successful trading strategies. Effective margin management is essential to limit risks and protect your capital. Spread. The spread is the difference between the bid and ask price. For example, if the euro to US dollar bid price is 1.3200 and the ask price is 1.3203, the spread is 3 pips. The spread represents the broker's profit, and your position must move by an amount equal to the spread to break even. Spreads affect your trading costs and can vary between brokers. We will discuss how to find the lowest spreads and reduce your spread costs. Spread rates directly affect your trading costs. Brokers with low spreads can reduce your trading costs, increasing your profit margins. Additionally, highly liquid markets typically have lower spreads, helping you reduce trading costs. Low spreads enable traders to trade more frequently, increasing potential profits. Major Forex pairs and their nicknames. The Forex market has some frequently traded pairs known as majors, including Euro to US dollar, Euro and US dollar, also known as FIBA. Pound sterling to US dollar, British pound and US dollar, known as cable. US dollar to Japanese yen, US dollar and Japanese yen, known as gopher. US dollar to Swiss franc, US dollar and Swiss franc, known as Swissy. Each pair has unique characteristics and trading dynamics. While the euro to US dollar pair has high liquidity, the pound sterling to US dollar pair can be more volatile. We will detail the strategies for trading each of these pairs and what you should pay attention to. Major pairs typically have low spread rates and high liquidity. These pairs are the most traded and commonly used currency pairs globally. Each major pair has its own trading strategies and dynamics. For instance, the euro to US dollar pair often has low spread rates, reducing your trading costs. However, the pound sterling to US dollar pair can be more volatile, providing potential for larger gains but also increasing risks. Understanding Forex currency pair quotes. Before trading currency pairs, you need to understand how to read the quotes correctly. Let's analyze the euro to US dollar pair. In this pair, the first currency, the euro, EUR, is called the base currency. The second currency, the US dollar, USD, is called the quote currency. If you buy the euro to US dollar pair, you are buying euros and selling US dollars. If the euro to US dollar pair is quoted at 1.3200, it means you need 1.3200 US dollars to buy 1 euro. If you sell the euro to US dollar pair, you will receive 1.3200 US dollars for selling 1 euro. The basic point of Forex trading is to buy a currency pair if you think its base currency will appreciate relative to the quote currency. If you think the base currency will depreciate relative to the quote currency, you would sell the pair. Understanding currency pair quotes is essential for developing successful trading strategies. Traders analyze currency pair quotes and price movements to develop their trading strategies. Accurately predicting currency pair price movements is key to making profits. Bid and ask price. The bid price is the price at which the market, or your broker, will buy a specific currency pair from you. For example, if the euro to US dollar bid price is 1.3200, you can sell euros to your broker at this price. The ask price is the price at which the market, or your broker, will sell a specific currency pair to you. For example, if the euro to US dollar ask price is 1.3203, you can buy euros from your broker at this price. The bid-ask spread is the difference between the bid and ask prices. If the euro to US dollar is quoted at 1.3200, 1.3203, the spread is 3 pips. The spread represents the broker's profit, and your position must move by this amount to break even. Bid and ask prices affect your trading costs. Brokers with low spreads can reduce your trading costs, increasing your profit margins. Understanding bid and ask prices is crucial for successful trading strategies. Conclusion. Today, we've covered some of the basic terms you'll encounter in Forex trading. Knowing the meanings and uses of these terms as you step into the world of Forex will help you build a successful trading strategy. From cross rates to exchange rates, from pip calculations to leverage usage, each term plays an important role in your trading. Understanding spread rates and how to trade currency pairs can help you reduce trading costs and maximize your profits. Forex trading may seem complex, but once you understand the basic terms and concepts, you can make more informed and confident decisions in the market. Remember, becoming a successful Forex trader requires continuous learning and adapting to market conditions. If you found this information helpful and want to learn more, please subscribe to our channel. We regularly publish informative and educational content like this. In our next podcast episode, we will cover more advanced Forex strategies and technical analysis methods. Thank you for listening, and we look forward to seeing you in the next episode. Goodbye.